We've just finished a case for somebody who's, believe it or not, used a big accountancy firm. They've got 15 holiday lets worth millions of pounds and haven't claimed their capital allowances. And let's just say we've saved them a hell of a lot of money. Get in touch with the team at Zeal to check that you haven't got any unclaimed capital allowances.
What are the key takeaways from the UK budget? Will your business rates be going down? And why do holiday let owners need to claim their capital allowances right now? Matt Jeffery from Zeal Tax is the special guest on the House Planet podcast, and he'll be answering all these questions and more on today's show. Matt, thank you for joining us on the House Planet podcast. What are the key takeaways from the recent UK budget which are relevant for short-term rental owners?
Hi, James. Thanks for inviting Zeal along again for another podcast. I know the tax ones tend to go down well, and not everybody likes to pay it, but if we can find some ways to reduce it, then that's great. Yes, we had a budget. Was it last week now? Time flies by, but I think it was, wasn't it, where Rachel Reeves announced some tax changes. Nothing really major. However, there was a change in income tax rates for property income, which holiday lets will be classed as property income from April 2025, as we know. So what that means is that they're going to add an extra 2% on the income tax rates that will charge to individuals that own and run their property business in their personal name. So whilst 2% doesn't sound like a great deal, actually it's a 10% rise. So if you're a 20% taxpayer, you'll now pay 22%. If you're a 40% taxpayer, you'll pay 42%. Now, one of the questions we've been asked quite a bit since this has come out is, do you pay 2% if you're in the 0% category? Well, the answer to that is no. So if your profits are below 12,500, including any other taxable income that you have, then you will still pay zero tax. So it will impact those who are paying tax at 20%, 40%, or even 45%. Taxpayers will go up to 47%. So that was probably the key change that will impact holiday let owners, or directly impact them. I suppose it's worth mentioning that corporation tax rates didn't go up. So if you own your property or run your business through your company owns the property and you run the business through the limited company, then that will have no impact on the tax you pay on your profits. However, dividend tax rates have increased. So they've gone up by 2% as well. And that's 2% on the basic rate and 2% on the higher rate. But the additional rate has stayed the same. Now, correct me if I'm wrong, but basic rate is 8.75% and it's gone up to 10.75%. And the higher rate is 2% more than what it was previously. So that means, so for those people who maybe not understand what dividends are, so you pay corporation tax on your profits, and then the profits that you got in the company, if you want to take them out into your personal bank account, then you have to pay dividend taxes to take them out. So it would be fair to say that companies or owners of companies will be impacted. However, there's obviously different strategies of extracting money from a limited company. So maybe paying a dividend or re-looking at your remuneration strategy, or you take less out of your company, might be a workaround there. So, on a positive, corporation tax rates haven't gone up, but obviously income tax rates going up isn't ideal. The other thing which has caused quite a lot of stir is the fact that personal allowances aren't going to be rising anymore until 2031. So it's been sort of being referred to as a stealth tax because, in their manifesto, the government said that they won't be putting up any income tax rates. Well, they did with the property and dividends, but your trading income or your employment income, that they're not affected. But by not increasing the personal allowance and actually increasing minimum wage and increasing state pension, what that means is that people who didn't pay tax previously will now start paying some tax at 20%, and those who were in the paying 20% might get pushed up into the 40% tax bracket. So it's a way of increasing income tax without actually increasing tax rates. So you could say that they're clever in one way, or you could look at it from a different angle and say that they're backtracking on what they said they were going to do. So they were sort of the main key tax changes affecting short-term net owners. Now, we weren't hoping for too many changes. We didn't get the VAT changes to VAT thresholds, which I know a lot of people were a little bit nervous about that. So I think if we take a positive spin on this, VAT thresholds are staying the same. There is a little bit of extra income tax to pay, but it could have been worse. I think I think a lot of people come away thinking wasn't too bad. So there are other sort of non-tax benefits as well. Do you want to cover them now as well?
Okay, real talk now for all you hosts out there. You know that moment when your guest messages you again with, "Hey, what's the Wi-Fi code?" Or you're staring at 5 different calendars, wondering if you've accidentally double booked the cottage. Yes, we've all been there. That's why here at Host Planner, we recommend Hostfully. It's basically your rentals control centre. It handles bookings across all the big platforms, syncs your calendars to ensure there are no double bookings, automates guest messages, and even creates these really slick digital guidebooks that stop all the repeat questions. Honestly, it just makes your life easier and keeps your guests happier, helping you achieve those all-important 5-star reviews. And here is a little bonus. If you're a Host Planet listener, you can get $500 off onboarding for Hostfully's property management software and 30% off digital guidebooks for life. Just hit the link in the show notes and use the codes PLANET500 for the PMS and HostPlanetGB for the guidebooks. And if you'd like a proper walkthrough, there's also a link to book a demo with Frank Bosey from Hostfully. He will show you how it all works. Less stress, more bookings, sorted with Hostfully. We'll just go over a couple of things. I mean, in relation to the dividends, like you mentioned there, you were right in saying it's gone from 8.75% for basic rate taxpayers up to 10.75%. The higher rate is 33.75% to 35.75%. So if you are having a limited company and paying yourself through dividends, that will have an impact. And I think just one thing to mention, as you kind of alluded to, it's a 2 percentage point rise, which doesn't sound like a lot, but actually is more. I wonder if you have kind of an example of where you can share kind of like how much it has actually gone up for some people.
Yeah, exactly. Well, if we keep the numbers simple, because none of us like doing maths, even us tax advisors and accountants, we've got computers who do it for us now. But let's say your profits were £10,000. Under the old rules, you would have paid £2,000 tax. Under the new rules, you'll pay $2,200. So that, in mathematical terms, is a 10% increase. So an extra £200 on top of 2,000 is £200 extra. It's worth pointing out, didn't mention it, that these rules don't actually come into play until January 2027 for income tax. The dividends will apply from 2026, but income tax rates, the first time you'll notice the extra tax you'll pay will be in January 2029, believe it or not, because it's tax year 27-28. So that finishes in April 2028, and then you'll have until January 2029 to pay your tax. So, there's a couple of years to go. Who knows what might happen in between then as well. So, it's not something that's going to have an immediate impact on holiday let owners, but in time, it will be, another added cost to contend with.
Yeah, and you're right in what you're saying there about the personal allowances as well. I mean, this is a massive stealth tax. And the main point with the personal allowances is if they would have gone up at the rate of inflation, that £12,500 would be a lot higher. The 20% rate would be a lot higher, which is currently at about just over £50,000, I think. And, the kind of middle earners keep getting dragged in to this 40% tax rate. And this is the issue. And if you do have a job and property income as well, it's likely that you are going to get dragged into this 40% rate, right?
Yeah, I was just looking at the statistics, but it was on average, the minimum wage has gone up by 7% over the last 5 years. And obviously state pensions will now increase above the threshold. Interestingly, the Chancellor said that they weren't going to go after pensioners for the additional tax. Now, to me, that's going to cause a bit of a few issues, because if you're not going to go after pensioners, why are you coming after me? So with a little bit of extra tax. So again, maybe some of they haven't quite fully thought through, but yeah.
Yeah, it all goes back to this debate about working people, doesn't it? Who is a working person?
Exactly. Yeah, exactly that,
we won't get into the politics of
No.
it. Your short-term rental business is evolving fast, but how do you keep up with the latest regulation, tax changes, and industry trends? The answer is to attend the House Planet Roadshow, which is coming to a city near you in 2026. This is the UK's premier event for holiday let professionals, supported by the Short-Term Accommodation Association, Price Labs, and the Women in Short-Term Rentals community. This is your essential opportunity for learning, networking, and expert insight. Starting in Cornwall on the 5th of February, you'll spend a full day mastering compliance, optimizing your revenue strategies, and sharing lessons learned with your peers. After Cornwall, we'll be in Portsmouth on the 4th of March and London on the 23rd of April. That's the day after the Short Stay Summit. Later in the year, we'll be heading to Nottingham, Bath, Chester, and Edinburgh. So don't navigate the complex 2026 market alone. Learn from the leaders driving the industry forward and shape the short-term rental conversation in your market. Tickets are just £40 each and available now from our website. Head to houseplanet.club for further details. I think what we should probably focus on a little bit, though, is having property in your personal name or a limited company, and kind of dig down a little bit there. So if you are somebody out there and you've got property in your personal name, should you be thinking about transferring it into a limited company?
Yeah, I think, it's a question that we get asked a lot of the time, and we do carry out a sort of a consultation where we'll sort of go through everybody's individual circumstances and try and plot out whether or not there is a benefit to incorporating that's the terminology, incorporating. So moving your property and business from your personal name into a limited company structure. Now, for some, there's some really great advantages of doing that. It can mean that you're going to pay less tax every year because, particularly if you've got mortgages and, companies aren't affected by the restrictions on mortgage interest deductions. If you've got other income elsewhere, then there's certain categories of owners that really would benefit from an incorporation. Generally, they've got multiple units. They are their earnings or profits, including other forms of income, are over, say, £70,000, £75,000. So there are these, certain owners, a group that could really benefit from an incorporation. However, there are another and probably a larger proportion, to be honest, that wouldn't really see any benefit from a limited company. I'm thinking more there's some people who don't have a mortgage, don't have much other income, these types of things. So it's a case-by-case basis, but there are some significant benefits. And, outside of just your normal annual taxes, using a limited company structure can potentially reduce your capital gains tax when you come to sell your properties, because the transfer from personal to company ownership will restart that clock for capital gains tax. But also it will give you some flexibility to plan for inheritance tax as well. And what I mean by that is that you can either create additional classes of shares, which can be owned by your dependents, your children potentially, where the growth in value of your business during your lifetime will then be in your children's estates rather than your estate. So called a family investment company. So quite a lot of people are looking at going down that route. And the other thing is you can gift some of those top class of shares, the A shares, to your dependents during your lifetime. So you can slowly move it out of your estate. So yes, for some, and I think if you're, if you're coming new into this industry, generally probably using a limited company is the right thing to do. Again, pros and cons of both, but I think it probably future-proofs you a bit more. So, if you're planning on scaling up over time, then, and even if that's not just holiday lets, that might be, buying a commercial property or a buy-to-let or whatever it might be, having that limited company structure will probably future-proof you against tax changes, which tend to always be targeted at the individual rather than the company. So my advice is that, if you think you're going to be affected by, all these changes, then, maybe reach out to Zeal and we can give you a free consultation to see whether or not it's worth you exploring an incorporation. And alternatively, those who are coming into the industry, probably using a limited company would be sensible, a long-term tax planning strategy.
Definitely, yeah. Speak to the experts, and we'll put all Zeal's contact details in the show notes. One thing to mention in relation to people who want to go from personal name to limited company, what's the stamp duty issue here?
Yeah, that's something that comes up a lot. And so when you transfer your properties or property to a limited company, it's treated as a sale at open market value. So that would naturally trigger capital gains tax and stamp duty. Now, if you're structured correctly and you do the transfer in the right way, it is possible to not have to pay stamp duty when you transfer capital gains tax as well. So individuals transferring properties to company will likely be subject to stamp duty charges. If you're a partnership or an LLP transfer into a limited company, then there is no stamp duty if the partners are transferring to a company that they own. Now, if you own your properties in your own name, but maybe you've got some family members who are interested in joining the business or already getting involved in the business, then actually forming a partnership with them. You don't have to legally change the ownership of the property. It still stays in your name until you obviously do the incorporation. But you could form a partnership, if there's a commercial reason to do so, and then that would give you the tax benefits going forward. So, as I said, incorporation is not for everybody, but for those that are either meet the criteria now or can put things in place so that they can in the future, then it's definitely an option, a restructuring option that they should consider.
Definitely, yeah. Speak to the experts, as we said. Was there any positive news from the budget?
You could argue that I think the business rates were highlighted as a positive change. So just to go over what happened there, when we had COVID, the hospitality sector were able to get 100% business rates relief. And then in more recent years, that relief has been tapered down. And prior to the last budget, those people who were subject to business rates, and we'll come back to that in a second, we're still able to get a 40% reduction in the hospitality sector in comparison to other sectors. So, your hospitality property would pay 40% less business rates than the office next door, say. Now, in the budget, they announced that they're no longer providing this 40% reduction for the hospitality sector. But to combat that, they are reducing the values of the multipliers, which works out how much business rates you pay. And they've been reduced sort of in line with what that 40% was. So that was highlighted as a benefit to owners, as well as, let's taking that step back to small business rates relief. So there's something called small business rates relief. And what that is that if your rateable value of your property in England is less than 12,500 and Scotland, and in Wales 6,000, then you can qualify for small business rates relief, meaning you don't pay any business rates. So the bit I talked about paying, the 40% reduction, etc., was for people who didn't qualify for small business rates relief. So that might mean because you've got multiple properties, you've got a really big property with multiple units, etc. But a lot of the owners that we speak to and are probably listening to this show would qualify for small business rates relief. And actually in the budget, what they announced was that if you had another property that would qualify for business rates, they won't remove the small business rates relief for a period of two further years. So what that means is that so often if you've got one and you add a second one, you're likely going to pay business rates. But with the new rules that they've announced, there will be a window where you won't have to pay for the two. So all positive news. But with every positive thing, there's always a negative. And what has been highlighted to the government is that whilst they've done these excellent, or what appears to be, excellent things by reducing the multiplier and giving the sector small business rates relief, well, next year, there's a new set of ratings list coming out. So every 3 years, they provide a ratings list, and the ratings list is the data basically from where they work out your rateable value. Don't ask me how you calculate rateable value. It's a complex formula, but it's based on things like market rents and this, that, and the other. But anyway, they work out your rateable value, then they apply it to a multiplier, but the multiplier has been reduced. Now, the issue is that we're expecting the new list that comes out in April 2026 for the values to be increased by approximately 30% is what's been published. So that means that actually the benefits that the government have announced to try and help the sector are going to be outweighed by these new rates new list of rates that's coming out. So PASC are actually doing a big piece on this. So they're the people who are consulting with the experts and taking it to Parliament to make them aware of what the changes are. So they will be providing some further information on that. So a plug for PASC, if you're not a member, join them, support them. They're working on your behalf, and they can give you all that extra information that that you're not going to get from an accountant. You're maybe not going to get online as well. So if you're not a member of PASC, join them. If you are a member of PASC, then they will be, if they haven't already, be providing some more information on the business rates changes.
Yeah, I've seen a few posts about this online, and I think there's a link where you can go and check exactly what your rateable value is and what you're going to be paying. And quite a few people were posting on social media saying, oh, mine's gone up 20%, mine's gone up 30%. So yeah, people I think are bracing themselves. So yeah, definitely check out PASC. They've got all the latest information on this, and we'll be able to help you if you've got any concerns in that area. Okay, then. So another thing we need to mention is that the government has been running campaigns about making tax digital. What do holiday let owners need to know about this?
Yeah, probably the hottest topic at the moment, the one that we're getting asked about a lot. So as holiday let owners, you're treated as landlords really now. And so if your income from your lets is £50,000 or more in the tax year that we're in now, the tax year, they're going to base it actually on last year's tax year. But obviously, if you know your results by right at the end of April, if your rental income is £50,000 or more, then you have to start making tax digital. From 2027, it will go down to 30,000 turnover, and for 2026, it's going to go down to 20,000. So what does it mean? Well, actually, it's not as complicated or as it sounds. What the government are trying to achieve is they're trying to get people onto to start keeping their records in a digital format. When I first started in tax 20-something years ago, I can remember watching people walking across the car park with carry bags full of invoices. In the last sort of 10, 15 years, we've moved on to spreadsheets, which are much easier and quicker to process. But, I think the next step is to be digitalized. And that means, using some kind of digital software or keeping your records in a format that can be digitally sent to HMRC or wherever it might be. So if you do meet the requirements, and I thought let's just cover off who doesn't have to do it. So if you are a partnership or a limited company, you don't have to do it. If you own a property jointly, say with your spouse, civil partner, or just a business partner, and your share of the rental income is less than 50,000. So let's give the example: husband and wife, £60,000 of rental income. So that's 30,000 each. You wouldn't have to do making tax digital until 2027. Now, all it means is that you either use a QuickBooks, Xero, Free Agent, whatever, whichever one we don't, have got any preference to. They're all pretty much the same. Every quarter, you need to press a button and say, these are my income and expenses for that quarterly period. They will not be audited by HMRC, and they will not form part of your final tax return. So at the end of the year, you will still do your tax return as normal. And if the figures are different to what you submitted, for whatever reason, you might have to give a refund. There might have been, a cost that was missed or whatever it might be, it will be only those figures that HMRC will be looking for. So you might ask, well, why? And I think that's what we asked, and the answer really is that they just want to get people into the habit of using digital softwares. So just if you're out there thinking, I'm too old for this, I don't even get a Wi-Fi signal where I am. If you think that actually, you don't think you'll be able to do this, you can apply for an exemption to HMRC. They've used things like age, Wi-Fi signal, these types of things. So you can apply for exemption. Just Google making tax digital exemptions, see if you fit into it, and you can then apply for an exemption. But other than that, there is things called bridging software out there, and what that is essentially an Excel spreadsheet which has got these sort of special macros or whatever they're called built into it that enables you basically to drag your income for the 3 months into a box for income and your expenses into a box for expenses, and that's it. So whilst it's not ideal and it's just another thing that you have to do and potentially another little cost to add, actually, if you can use an accounting software, get into the habit of doing it, it will reduce your accounting costs at the year end because you'll have it all there for you. It will also give you the ability to track the performance of your holiday let on a monthly basis, on a weekly basis. It'll make sure that all your records are in one place. You can take photos of your receipts and it sends it to the software, and that's it. You can bin it then. So there's lots of good reasons for doing it, and that's why HMRC want people to start doing that. So yeah, it's there's plenty of information out there on making tax digital, but I think the message that we're trying to get across is that don't panic. It's not a particularly difficult task, and you've got some time to prepare for it. Even if you're, let's say you've got to do it from April next year, well, actually your first filing will be 3 months after, so it will be end of June or whatever it is. So you've got a bit of time, and they have said that they're not going to be charging penalties at the start or for the first 12 months. So that isn't a reason to not do it, but it is a reason. It does give you some comfort that if you get it wrong or you're a bit late to the party, then there shouldn't be any financial consequences. But trust me, they won't last long for doing that. And if they know you're willingly not trying to do it, then I suspect they'll still charge you a penalty. So yeah, I think the message is to try and get on top of it as soon as possible. We will be releasing Zeal. There is already something in the resource hub which is available to Host Planet listeners that about making tax digital. But we're in the process of we've been trialing a few of the different softwares, and we're going to just release a blog on that. So give you an idea of the different ones out there, cost effectiveness, usability, that type of stuff. So that should be out sort of early in the new year.
Great, and we'll put some links to that on Host Planet channels. I'm just thinking, I'm sure there'll be people out there thinking, will my accountant just deal with this? And I'm probably one of those people.
I think ideally it depends. I've spoken to a few accountants, and there's a range of what they're doing. Some are taking the opportunity to charge more to do some more work. Others are encouraging their owners to get onto and helping them to get onto accounting software, because if I owned an accounting practice, I'd want all my clients to be on a digital accounting software. So I would be taking this as an opportunity to get people onto accounting software, because it makes the accountant's job easier. It can reduce your fees. But yeah, don't rely on your accountant to do it for you. Certainly not. And don't even rely on them to be letting you know that you need to do it. Whilst you might think you're important to and you might be important to your accounting practice, they'll have lots of people who are probably not just holiday let owners, and so they might send out the communications, and if you don't read them, they're not going to be, they may or may not be ringing you up and saying, "Don't forget to do this." So take responsibility. As UK taxpayers, we have to take our own responsibility for things.
Sounds good. Okay, then let's finish with capital allowances. Then there'll be people filling in their tax returns, and also we need to be clear that capital allowances, they are coming to an end. So I think quick overview, what are they? And if you're a holiday let owner and you haven't claimed them, why do you need to be getting in touch with Zeal soon?
Yeah, sure. In real quick times, most owners of holiday lets, you would have claimed some capital allowances, and you think we've probably claimed our capital allowances. The key message is that there's an extra layer of cap allowances on the purchase, refurbishment or construction costs that you've incurred. Even if you incurred them 5, 10, 15 years ago, there's a small window of opportunity now to be able to identify any misclaims and claim them in your 24-25 tax return. For those of you already paying tax, excuse me, I've paid tax in the last couple of years, there's no better time to be looking at your capital allowances now, because you can effectively go back a couple of years, get some cash for payments. We've just finished a case for somebody who's, believe it or not, used a big accountancy firm. I've got 15 holiday lets with millions of pounds and haven't claimed their capital allowances. And let's just say we've saved them a hell of a lot of money. So don't assume or presume, never assume or presume. Get in touch with the team at Zeal to check that you haven't got any unclaimed capital allowances. It's a quick thing to do and can save you tens of thousands of pounds. So I know we keep going on about it, but there really is a small window now. And, if you've thought about it or been thinking about it, now's the time to act.
Yeah, I mean, the vast majority of holiday let owners in the UK have not claimed their capital allowances. And honestly, it's just going to mean they're going to pay a lot more tax. So Matt, just tell us, when is the actual deadline? When do people have to get in touch with you to have that discussion about capital allowances if they haven't already?
Yeah, so the hard deadline will be January 2027, and that's the deadline to amend your 24-25 tax return as individuals. If you're a limited company, it's going to be around early 2027 as well. Might even be end of 2026 for some. But if you're doing your tax returns at the moment and you've got tax to pay or potentially got tax to pay, get in touch as soon as possible so you can make sure that we can get your claim done by the end of January.
Definitely. Make it a New Year's resolution if you have to. Claim your capital allowance. We could not be clearer. Matt, it's been a real pleasure as ever. Thanks for joining us on the Host Planet podcast.
Always a pleasure, James.
Great to chat to Matt Jeffery there from Zeal Tax. Make sure you claim your capital allowances right now. That's just about it for today's episode. Remember, this podcast is brought to you in collaboration with Hostfully, which is trusted by short-term rental professionals across the globe. As a House Planet listener, you get 2 exclusive offers: $500 off onboarding for Hostfully's property management software. Just use the code PLANET500, and 30% off digital guidebooks for life. Use the code HostPlanetGB. To grab these deals, click the link in the show notes or head to hostfully.com. For more free education, tips and trends from the STR industry, visit houseplanet.club, where you can sign up for our newsletter, listen to our podcasts, and download a suite of ebooks for hosts and property managers. That's it for today's episode. Until next time, happy hosting.